Why one should invest for a longer period of time? Focus portfolio are easier to manage. What are the different parameters to focus on for higher conviction? And review the portfolio quarterly or half yearly. Let us first understand what exactly does portfolio mean. The process of blending together the broad classes so as to obtain return with minimum risk is called portfolio. Portfolio is designed to suit investor requirement, which involves making several projections regarding the future based on the current information. Or you can say that it is a combination of securities such as stocks, bonds, and money market instrument. Portfolio is basically built to suit the return expectation and the risk appetite of the investor. What are the different determine appropriate asset allocation which are based on individual financial situation? Basically, before making any investing decision, the first step is to understand our risk and your goal. Let's suppose you can say that an investor want to purchase a car, say after 4 years, so he will not invest 100% in equity. He will invest somewhat in equity or in debt. Let's say example 60-40 ratio. Majority of the increase with that. In other words, that there is no guarantee that you will make money from your investment. But if you get the facts about saving and investing and follow through with that particular plan, you should be able to gain financial security over the years and enjoy the benefits of managing your money. The one of the most important factor which should be taken into consideration is investing right time of investing. The younger you are, and the more time and energy you would have left to cover your loss if anything goes wrong. The older you are, the less time and energy you would have to do that. Hence, you can say that younger people would tend to have a larger capacity for risk than older people. Next comes to in our mind is risk diversification. Basically, diversification is the most important component of reaching long-range financial goals while minimizing risk. It is a technique that reduces risk by allocating the investment among various financial instruments or industries and other categories. Basically, investor should invest like for example, if you say that an investor want to start is investing their money in equity, so that he should not invest 100% in a one sector. He can invest 10% in auto sector, 20% in pharma sector, and so on. Or you can say that if suppose you have a portfolio of only airline stocks and it is publicly announced that crude oil prices suddenly increases, then share of airline stocks will drop. Your portfolio will experience a noticeable drop in value. Like, why should one invest for a longer period of time? If you see this particular table, you will come to know that if you for a 5-year return, there is almost 10% increase. Or during any particular short period, you could face poor return or even losses. These are compensated for only by the occasional great phase. Let's look at it from a different perspective. The equity market moves in cycle, and often it takes 5 to 7 years go through a full cycle of sharp rise, followed by a decline and stagnation. To get the right level of return, we need to keep investing throughout the whole cycle, and that won't happen in a year or even two. You can say that sugar sector. If you see last 2 year return of sugar sector, you will come to know that you have to invest for at least 4 to 5 years to get a particular return, to get a certain amount of return. Or there's a yet another way of looking at it. We found that on an average, if you invest through a systematic investment plan over 4 years, your risk of making a loss is negligible. So there is your answer. In equity and investment, long term is not a way, and medium term, which can be defined however someone wishes. It's almost 5 years and above. Now, focus portfolio are easier to manage. A portfolio is said to be efficient when it is expected to yield the highest return for a level of risk accepted, or alternatively, the smallest portfolio risk or a specified risk. One should invest in two to three stocks and a good quality stock rather than invest in 100 stocks. If you have only two to three stocks, then it will be easier for the investor to go through it and rebalance it also. We have earlier seen that diversification can help an investor manage risk and reduce the volatility of the asset price movement. Remember though that no matter how diversified your portfolio is, this can never be eliminated completely. Now, what are the different parameters to focus on for higher conviction? One of the most important component investors should focus is to growing sector. If you see that auto sector, that past 1 year return has been increased by 10%, or you can say that 15%. So for a beginner, it is the right time, like it is the right growing sector is one of the most important component to invest in that sector. Business model basically is the describe the rationale of how an organization creates, deliver, and captures value. Basically, it tells the mission and vision and what are the different strategies that the management are adopting to achieve it. You can say that capital intensive and asset allocation. It tells us from where the company is getting capital and how they are investing it, or you can say that how they are using their asset to generate cash. Financial track is basically the most profitable and is capable of increasing its profitability at a good consistent rate. To grow its profit, a company must be able to grow its net sales year after year. The company can achieve it by increasing capacity in existing infrastructure and by expanding its business in the long run. Basically, investors should focus the company in which profit has been increasing year quarter by quarter. Not either like not investor should not invest in that particular sector that the one quarter has been increased by a certain amount, that he should not invest in that particular company. So he has to focus past 2 3 year financial performance. Clean corporate governance is basically like the company should be able to pay their tax, their working capital should be high, their working capital should be good, and its parameters should be in line with the industry. Basically, if the company having a good working capital, then it can invest in some other it can diversify their business into different sector also. Valuation is the single most important concept in the finance, and it is something that every investor should know something about. At the end of the day, each of us to create value. Like for a valuation, it should be the company should have a low P, high ROE, and it is having a good strong operating cycle, operating cash flow. So these are the certain parameter which one investor should focus on. Now the question arises when one should review the portfolio. Now your portfolio has a job to do. Its main objective is to ensure that you stay on track and you reach your financial goals on time. Now the question arises, how often should you look at your portfolio? For most people, quarterly are more than enough, and for some people, even that could be too much. No doubt, checking your portfolio too frequent can do more harm than good. Most experts, or you can say that research say that once a year, maybe twice is plenty. A younger investor can just invest and not check that portfolio for as much as a year. But someone who is close to retirement and can't afford as much risk needs to check on the strategy more frequently. Now, if the returns have fallen short or if it is more volatile than you expected, then it's time to revise that investment. A good way of rebalancing is through using your contribution. If you see that you are drifting away from your target allocations, put more into those assets that have underperformed and less into those that have done well. This avoids concentration and also puts you in a better position from a risk perspective. Thank you. If you have any question, you can ask us.